If you are 65 or older and you are getting ready to file your taxes, or you have already filed, stop right there. There is a very real chance the IRS owes you thousands of dollars and you have absolutely no idea. A brand new rule just took effect this tax season, and if you miss it, that money does not roll over to next year. It is gone. By the end of this video, you will know exactly how to claim up to $6,000 or $12,000 if you are married, without overhauling anything else on your return. And make sure you stay with me, because later I am going to cover the exact mistake that is silently draining hundreds, sometimes thousands of dollars from senior tax returns all across the country right now. Here is what you need to understand first. Every year, the IRS taxes you based on something called your taxable income. That is your total income minus whatever deductions you are allowed to subtract. The more deductions you have, the lower that number gets. The lower that number gets, the less tax you owe. That is how the whole system works. And that is precisely why what Congress just changed is so significant for anyone over 65 this filing season. Thanks to a new law called the One Big Beautiful Bill Act, signed into law in 2025, there is now a brand new deduction created specifically for seniors. It is called the Senior Bonus Deduction, and it is worth $6,000 per person. If you are married and both you and your spouse are 65 or older, that climbs to $12,000 combined. This is not replacing anything you already had. It stacks directly on top of every other deduction you were already entitled to. And here is the part that makes this especially powerful. It does not matter whether you take the standard deduction or whether you itemize. Either way, you can still claim this $6,000 senior bonus. That kind of flexibility is rare in the tax code, and it is worth paying close attention to. Now let's get into who actually qualifies, because the rules matter. You must be 65 years old or older by December 31st of 2025. If your 65th birthday is January 1st of 2026 or later, you do not qualify for this particular tax year. This applies to your 2025 tax return, which you are filing right now in early 2026. There is also an income limit. Single filers need a modified adjusted gross income under $75,000 to receive the full $6,000 deduction. Above that, it starts to phase out gradually. For married couples filing jointly, that limit is $150,000 combined. For the large majority of retirees living on Social Security, pension payments, and retirement account withdrawals, you are very likely going to qualify for this deduction in full, or at least a significant portion of it. When you stack the base standard deduction, the existing age-based deduction that seniors have always received, and this new $6,000 senior bonus together, the total amount you can subtract from your taxable income this year is the highest it has ever been. For a married couple where both spouses are 65 or older, that combined total can approach or even exceed $46,000. That means if your household income falls below that level, you may owe zero federal income tax this year. And if your income is above it, you are still going to owe considerably less than you did in previous years. Now here is something that is catching a lot of seniors off guard this filing season, and it is costing them money. Many retirees have been itemizing their deductions for years, sometimes decades. They list out mortgage interest, charitable donations, medical expenses, property taxes, and so on, because that total used to beat the standard deduction. But with these new higher deduction amounts, that math has changed for most retirees. If you have paid off your home, you no longer have mortgage interest working in your favor. Without that, it becomes very difficult to accumulate enough itemized deductions to outperform the new standard deduction with the senior bonus included. Do not assume that because you have always itemized, you should keep doing it this year. Run the numbers carefully, or let your tax software do it for you, because for most seniors in 2026, the standard deduction wins. The one exception worth knowing is large medical expenses. The IRS allows you to deduct medical costs that exceed 7.5% of your adjusted gross income. If you had a major surgery, a significant hospital stay, expensive dental work, hearing aids, or other substantial health costs last year, it is worth calculating whether those expenses push you far enough past that threshold to make itemizing worthwhile. For most seniors with average healthcare expenses, they usually do not clear the bar set by the new higher standard deduction, but it is always worth checking. Let's talk about the forms, because this is where real mistakes are happening right now. If you are filing a paper return and you are 65 or older, you need to be using Form 1040-SR, which is the U.S. tax return for seniors. It is designed specifically for you, it has larger print, and it includes a built-in chart for calculating the senior standard deduction. There is a checkbox on that form for people who are 65 or older, and checking that box is what activates the age-related deductions you are entitled to. If you skip that box or use the wrong form, you could miss out on thousands of dollars. If you are filing electronically, good tax software should detect your age and apply the correct deductions automatically, but do not just assume it happened. Scroll through your return and confirm that the $6,000 senior bonus deduction is actually showing up. That one check could be worth more than an hour of your time. Social Security and taxes is another area that creates a lot of confusion. Many retirees assume their Social Security benefits are completely tax-free, but that is not always true. If you are a single filer and your combined income, meaning your adjusted gross income plus half of your Social Security benefits, is between $25,000 and $34,000, up to 50% of your benefits may be taxable. Above $34,000, that rises to 85%. For married couples filing jointly, those thresholds are $32,000 and $44,000. The good news is that the new $6,000 senior bonus deduction works directly to offset that tax. For lower-income seniors, this new deduction could eliminate federal taxes on Social Security income entirely, which is significant relief for anyone on a fixed income. If you are 73 or older and you have a traditional IRA, 401k, or similar retirement account, you are required to take a minimum distribution from that account every year by December 31st. This is called a required minimum distribution, and if you fail to take it, the IRS charges a penalty of 25% of the amount you were supposed to withdraw. That is not a small consequence. When you take your RMD, that money counts as taxable income, but with the new senior deductions in place, some of that income can be offset, which reduces what you actually owe. If you are not confident preparing your own return this year, free help is available. The AARP Foundation runs a program called Tax Aid with thousands of locations in libraries, community centers, and senior centers across the country. Volunteers trained specifically on senior tax issues will prepare your return at no cost. You can find a location at aarp.org/tax or by calling 888-AARP now. The IRS also offers a free file program at irs.gov. If your income in 2025 was under $89,000, you can use professional-grade tax software completely free through the IRS website. No fees, no subscriptions, no catch. One more thing you cannot afford to ignore this season. If you sold items online through platforms like eBay, Facebook Marketplace, or Etsy and received $600 or more in total payments, that platform is required to send you a Form 1099-K and report it directly to the IRS. Many retirees are receiving this form for the first time and are unsure what to do with it. If you sold personal belongings for less than you originally paid, you generally do not owe tax on that, but you still have to report it correctly on your return. If you ignore it entirely, the IRS computer system will flag your return because their records will show income that yours does not, and that can trigger a notice or delay your refund. The federal filing deadline is April 15, 2026. You can file for an extension to October 15th, but understand that an extension to file is not an extension to pay. If you owe taxes, you still need to estimate that amount and pay it by April 15th, or you will face interest and penalties on whatever is late. Filing electronically with direct deposit is the fastest way to receive your refund, typically within 21 days. With all the new changes this season, the earlier you file, the better. This year is different. The rules have changed in ways that directly benefit seniors. but only if you know about them and only if you claim what you are entitled to. The $6,000 senior bonus deduction does not apply automatically. You have to file and make sure it is included on your return. Please pass this along to anyone you know who is retired or approaching retirement age, because most people have not heard about this yet, and every senior deserves to keep every dollar the law says they are owed.